Thank you very much for joining us today. My name is Patrick Ray. I am one of the AT&T focused retirement advisors here with the Retirement Group, and we appreciate your attention this afternoon. We're going to bring to you some material that's really relevant to the current environment and how it affects some of your retirement planning decisions, for sure, from a tax perspective and amongst other things. But before we get started with today's material, I want to make sure we're all on the same page on a few things. First and foremost, we are not affiliated in any way with AT&T, nor are we affiliated with Fidelity. And as it turns out, our experience comes with the thousands of people literally that we have met with over the years, from physicians who are in similar situations as yours and trying to help them achieve and maintain a successful retirement. And one of the tools that we utilize in an effort to do so is this webinar platform, where we bring you the most current, up-to-date, and relevant topics that we think you should consider and give you things to think about with respect to getting prepared to make one of the most important financial decisions that you will ever have to make. We also bring other things to the table, like we have an ebooks library that's full of short to read things on topics that we get asked on a number of occasions and topics that you can find a link into the chat to get access to. We also have a way to stress test your overall retirement plans by doing a complimentary analysis through a cash flow projection, which is a stress test of where you stand from meeting your overall goals and objectives. And if you're willing to spend a few minutes with us, we're delighted to give that material and data to you to help you analyze and better understand where you stand from a retirement planning perspective overall. And last but not least, we'll also be dropping a link into the chat with another AT&T specific webinar that you'll be able to sign up for going forward. So look out for that. And last and maybe the most important, in the event that you have questions or concerns about specific things, feel free to drop the questions into the chat box so we can get an answer for them to you at the end of the webinar. And we'll give you ways to get in touch with us when the presentation is over. So without further ado, I'll bring on today's guest speaker, Tyson, and talk about material today. Tyson.
Thank you, Patrick. Thank you, folks, for attending our webinar series this afternoon. My name is Tyson Mavar, one of the AT&T focused retirement advisors for the Retirement Group here in Texas. And here we are in 2022. A lot has happened. Many of you may have already retired and left the company before the end of last year to avoid losing some healthcare benefits or some money in your pension. Most of you, I imagine, are probably still working at the company and maybe lost some coworkers last year, but have seen a lot of changes happen within the company. Changes to your AT&T stock, changes to the pension formulas, changes to the benefits plans. And what we'll talk about today is some potential changes to tax rules that affect your benefits, as well as the changes that we've already seen here in 2022 on the interest rates that affect your pension lump sum, and some very important considerations that we want to impress upon everybody that's on today's webinar, and really everybody at AT&T who's approaching retirement, in terms of getting the timing right of your exit from the company so as to not leave any money on the table or to harm your overall probability of success in your retirement plan. So Patrick mentioned a little bit of our company. We've been in business for over 30 years. We've worked with AT&T employees our entire history of being in business, and we have thousands of clients from AT&T, some of them still working, but many of them retired, who are relying on myself, Patrick, and a number of our representatives to keep them out of trouble, make sure they don't make mistakes with all of these decisions that you'll go through as you transition from the company, as well as what you'll have throughout your retirement. There's some complimentary services we encourage everybody to take advantage of. The cash flow analysis, I would say, is probably the most useful in figuring out if you're saving enough, when's a good time frame for retirement, what are the benefits and potential detriments of different pension options and healthcare options, and also the tax strategies that might be the most efficient for you and your family, depending on your circumstances. All of these issues we look to shed some light on when we go through this cash flow analysis, so that you can have a good idea of what's going to likely be the most suitable plan for yourself, given that everybody's circumstances are different. So take advantage of that if you haven't already, or if it's been a while since we've updated it. Please let us know so that we can update your retirement plan for you. And I encourage everybody to follow us on LinkedIn if you're not doing so already, because that is where we will publish and post a lot of these live videos that we do, so that you can peruse some of the topics that are most interesting to you at your own leisure. Now, we've had already some tax rule changes in the last couple of years, and we're anticipating more tax rule changes in the coming years that will potentially have a very big impact on the retirement plans and decision-making process for AT&T employees. So let's talk about a few of these issues. We had changes to require minimum distributions. This age used to be 70 and a half. Now it has changed to 72. And it's possible that could change again in future years to a later age. Now, this is actually a benefit to folks that maybe have a modest standard of living in retirement, or maybe did a really good job of saving relative to what their lifestyle is in retirement, but not forcing folks to pay taxes when they don't necessarily need the money from their retirement plan. But this is something that we build into the plan on strategies for getting ready for your RMDs, and maybe considering some tax strategies such as Roth conversions, distributions from your IRA. If estate planning is important to you, maybe even incorporating life insurance into the plan so that you're not overpaying in taxes, and so that you and potentially your family get to keep as much of your money as possible. We've also seen some changes to the rules of beneficiary IRAs and retirement accounts that are inherited by specifically non-spouse beneficiaries. So these unfortunately have not been beneficial, the changes that have been enacted. And if you have not done so already with either your estate planning attorney or your advisor, this may be something that you need to revisit on your plan to make sure that you're not in a situation where your beneficiaries that inherit any of your retirement dollars, or maybe you are the beneficiary, and this is something that as a beneficiary of your folks or a family member want to discuss with your family to make sure that the plan is still consistent with the rules and regulations related to inheriting retirement accounts for non-spouse beneficiaries. So we talk about this as well in our retirement cash flow analysis. And if you're a client of ours and we haven't discussed this yet, make sure that on our next meeting, we discuss this to make sure your plan is still consistent with the new rules and regulations around inherited IRAs. Now, there are some, or were some age restrictions. Now those have been lifted in terms of contributing to a retirement account after the age of 70 and a half. You can now do this, but you still have to have earned income. So that's something that for anybody who still has a job, whether it's part-time or full-time after 70 and a half, something we may want to consider as well to bolster your retirement plan. And now we also have the tax brackets, both for ordinary income taxes, which we see here. The thresholds have changed a little bit. The actual tax brackets have not. That could be something that changes next year in 2023. We'll keep everybody posted as we get closer to the end of the year when those changes are likely to be enacted, if they do. Also, we have the capital gains tax brackets, which have not changed, but the thresholds have changed. So these are for selling appreciated assets in a non-qualified or non-retirement account, something we also spend a lot of time with our clients that have had an opportunity to save in non-qualified accounts to make sure that these accounts are being distributed and also traded efficiently so that you're not overpaying in taxes, and we can stretch out the assets as long as possible, being considerate of your lifetime tax bill and not just this year's tax bill. We also have clients that move in retirement, and as it turns out, different states tax income differently. And it's not about where you earn the money, it's about where you distribute the money. So where you reside in retirement, and maybe you have multiple residents, this is probably also an important consideration for anybody that is considering leaving, whether it's to follow the grandkids or the children. Maybe it's to get further away from your children in retirement, or maybe it's to downsize or just live somewhere that's less expensive, maybe quieter. We build this into our retirement cash flow analysis so you can see what are the financial impacts of living in different places in retirement. Maybe it's not even in the US, maybe it's outside the US. But the taxes as well as the cost of living, we think is very important to consider before making that decision on where your forever home might be. All right, we're going to talk a little bit about the current changes and the proposed tax rule changes. There was a lot of changes as a result of the pandemic in terms of government spending, in terms of monetary policy easing and reducing interest rates to stimulate the economy. A lot of tax code changes to help people through the pandemic. Some of them, may or may not have made sense, but there is likely going to be some long-term detriments of some of the government spending and stimulus that was enacted in the last couple of years. And we may all have to tighten the belt a little bit in an effort to pay for some of these deficits that we've gone through in the last couple of years. There's some proposed changes coming up specifically to the marginal tax brackets and raising the highest tax rate to 39.6%. Changes to long-term capital gains tax rates, as well as all of the ordinary income tax brackets. Changes to the net investment income tax and how broad that tax is applied, as well as potential changes to the step up in cost basis, which is a tax advantage for individuals who pass away with non-qualified assets that had appreciated in value in an effort to increase our tax revenue. We may see some of these tax rules becoming less and less favorable for individuals during our retirement, as well as beyond our retirement or after our lifetime. And there's also some changes to the extended child tax credit. Some of the changes as a result of ARPA potentially becoming permanent, and the expanded health insurance premium tax credit potentially becoming permanent. All of these things, many of them affect lower income households more than the higher income households, but things that we are going to be watching as we get to the end of 2022 and prepare for future years for our retirees. All right, so now let's talk a little bit about some more advanced tax planning. And first and foremost, the interest rates and where they are today that affect the AT&T pension lump sum. Now, this is most employees we work with, SBC Heritage, or what they call Legacy S, the Legacy T employees, Legacy AT&T employees, and even the non-management employees and a variety of employees throughout the country will have a lump sum pension that's affected by interest rate changes. Now, last year, we didn't know what was going to happen with interest rates. We thought there was a possibility they may go up, and they did go up quite a bit, but they went back down before the end of the year to a point where it was not a major detriment to employees who stayed on payroll. In other words, a lot of people didn't lose that much money on their lump sum come the turn of the year or January 1st. Now, interest rates have gone up very quickly to a very high degree here in 2022. And we've seen it everywhere in borrowing, whether it's credit cards, mortgages, auto loan, with our bonds, the interest rates that our bonds are paying, and also the value of our bonds as interest rates have gone up. Some of our long-term bonds have gone down in value. But this also affects the pension plan. So I'm going to zoom in here so we can look a little bit closer at some of these rate changes. So if you look at the bottom table, you can see what the rates have done over the past 5 years. At the top, you can see what interest rates did in November of 2021, which affects the lump sum recipients for 2022. These are still relatively low interest rates. We focus mostly on the second segment rate because it has the most impact on the pension calculation. So that came out at 2.72 in November of 2021. So that's what rates will be used for the second segment lump sum calculations for anybody who retires this year and takes their pension by this year. That is substantially lower than what we saw, especially in 2019. The rates were more than 1.5% higher than they are this year. So lump sum payouts were a lot lower back in 2019 than they are here in 2022. However, if you look at the top of the screen here, you can see the most recently published interest rate was April of 2022, and the interest rates have already increased by 1.5% just in the last 6 months. Now, we don't know what's going to happen throughout this year. Remember, November is the relevant month, and of course, interest rates could go back down between now and November, but they could also go up even further from April to November. But if they stay flat throughout the year, that's a 1.5% increase, which could result in about a 15% drop in your lump sum payout. Could be less or more depending on your age. But the importance of this is that we are still about 6 months away from the end of the year. So you have time to prepare for this, rerun your pension calculations to see how much money you could potentially lose if rates stay flat, or if in worst case, they continue to go up maybe to 2 or 2.5% higher than they were last November. See what the dollar losses on your lump sum will be for working into next year. And we might want to consider a different retirement plan, a different timing, maybe leaving AT&T and getting a part-time or full-time job next year or later. Could mean a different tax strategy. I have one client of mine that been working together for a while, and he was noticing that his pension was going down by close to $100,000 given the current rates into next year. And his thought, at least at first, was that now the market's down right now, it's not a good time to retire. I may just work a few more years, even though I'm going to lose money on my pension, just to make back what I lost in stocks and in my pension. This is a common consideration for people, whereas assuming that, given the market losses that we've seen this year, assuming that you are confident markets will eventually, inevitably return or go back up to their previous highs, this could be a great opportunity for investing, especially money in a lump sum. We prefer to invest money after markets went down rather than at like an all-time high, which is where we saw close to the end of last year. So it could be a great time to take a lump sum at the end of the year, depending on what markets do, depending on what interest rates do. This is what you should be thinking about and talking about with your advisor, whether it's us or one of our peers in the industry, and also talking about your coworkers to what their thoughts and ideas are, but just making sure that you are understanding the implications of a lot of these changes on your overall retirement plan, we think is critical. Now, when you do leave the company, you have an option to take the annuity on your pension, of course. You have an option to take a lump sum, roll it over, invest that money, have a little bit more control over it. What option makes the most sense is a function of a lot of different variables that we talk about in our cash flow analysis, and we encourage people to spend a lot of time thinking about so you can make a confident decision when the time comes. If you do take a lump sum, you have the ability to roll that money over and defer taxes. You don't have to pay taxes immediately on that lump sum. If you roll it over correctly, either to a traditional IRA, it's typically the most common and advisable strategy, or even to your 401k plan, or maybe a combination of the two. You can also move those funds to a Roth IRA, but you will have to pay taxes on whatever amount moves to a Roth IRA in the year that you do your rollover. And oftentimes that's not advisable for the tax implications, but no taxes on a qualified rollover until you withdraw the money, hopefully slowly over time throughout retirement, so you can extend that money over the rest of your life. Now, if you do have any after-tax contributions in your 401k plan, these monies can be rolled over directly to a Roth IRA with no tax implications. You may also have some Roth 401k contributions that might have to be handled a little bit differently than your after-tax, or what we call spillover contributions. So there's a lot of source-specific information that we want to be aware of before making these decisions. And this, again, is something that we will go through in our cash flow analysis so that we can start building a tax strategy, an efficient distribution strategy for your assets. So again, you're getting to keep as much of your money as possible and not overpaying in taxes, just paying your fair share and not having to pay some of the penalties that can plague a retirement plan for folks that aren't aware of all the rules. Now, there's also some distribution strategies that we focus on with our clients in making sure that they're getting their monies in retirement as efficiently as possible. These are probably, I would say, the most common conversations I have with my retirees, other than just discussing their current allocations, considering rebalances, and considering changes to the investments. We often will talk about how to get money in the most efficient manner possible, not just normal monthly withdrawals, but also those one-time withdrawals that inevitably are going to come up. And there's a conventional withdrawal strategy, but also a tax-informed withdrawal strategy that we encourage people to discuss and talk about and understand before taking large withdrawals that end up have them overpaying in taxes over their lifetime. So the conventional withdrawal order is you spend your taxable money first. Spend the money that is after tax, but that is taxed on an annual basis. We call these non-qualified accounts. Be like cash in the bank or a brokerage account, non-retirement accounts effectively. Then once that money is spent, spend your tax deferred money. This would be your IRA money. This is what most of our clients have most of their assets in. Pension lump sum, most of your 401k is probably tax deferred. And the conventional order is to spend those monies second. And then the last bucket to draw from would be your tax exempt money, your Roth IRA money, and the money that can grow tax-free for the rest of your life, because we'd like to really squeeze as much tax advantages out of that long-term tax-free growth as possible. Well, this unfortunately does not consider the long-term tax impacts and the progressive tax system that we have, the tax system wherein the more money we spend, the higher our tax rate goes. So I'll zoom in here. This is that conventional withdrawal strategy where taxable money got eaten up pretty quickly for this individual. They also qualified for Social Security and decided to take it, it looks like in their case, at full retirement age at age 67. So that reduced a little bit of the burden on the withdrawals from the retirement accounts and had their total taxes paid $36,402 in this individual's example. Now their income need was only about $60,000 a year. And so we've compared this to what we consider to be a tax-informed withdrawal strategy to show you how you can have a more efficient tax strategy to pay less in taxes over your lifetime. Here's the tax-informed withdrawal strategy, where we would actually like to fill up the lower tax brackets with taxable withdrawals. So withdraw money from your IRA/401k, but only withdraw a certain amount of your total income for those years. And then to avoid dipping into the higher tax brackets, we would spend tax-free and tax-exempt dollars so we can manage our tax bracket better. In this individual's case, they had an extra 2 years of sustainability of their retirement plan. Their money lasted 2 years longer because of the additional $36,000 in tax savings they had just by structuring their withdrawals differently. They had the same amount of savings, the same growth rate on their money, but by taking money out of different buckets based on this tax-informed strategy, their money lasted 2 years longer. So very critically understand this, and very critical whoever you work with as an advisor in retirement understands this and also spends time to evaluate what's going to likely be the most efficient withdrawal strategy, or what we call distribution strategy, on your retirement plan given your circumstances. So just going over the bullet points here: fill up the lower tax brackets with tax deferred income each year. Be aware of the implications on your Social Security benefits on not only your taxes, but how that income plays a role into your total income. And then strategically utilize taxable and tax exempt assets to keep you out of the higher tax brackets, or to manage your tax brackets throughout your retirement. Now, we also have some special tax situations. These are for, in many cases, for our clients that leave AT&T before 59 and a half and need to generate some kind of income. It might not be all of their income, might be just a supplement to either a part-time job or a pension income or some non-qualified money they were able to spend, or maybe a spouse's job. There's a lot of ways to generate income, and these are some of the exceptions that allow you to avoid the 10% early withdrawal penalty. And there are many of them, but the one that usually makes the most sense, you have to work until the year you turn 55. You cannot leave AT&T until at least the year you turn 55, and you can gain a lot of flexibility in your retirement plan to avoid not only penalties, but also have flexibility on how much you're spending in those early years of retirement, and just have your money lasting longer because your total taxes was lower. But there's a lot of these exceptions. So talk to your advisor or talk to us about how these exceptions might play a role into your retirement plan, given your age when you leave the company, the year you're planning to leave, and the other resources that you have available other than just your pension and 401k. Now, we talked about the required minimum distributions at 70, now 72. We talked about the early withdrawal penalties at 59 and a half. Well, in between ages of 59 and a half and what is now 72, you have complete flexibility on how you can spend money, but we want to be strategic about that flexibility that we're afforded, so that once the rules kick back in at 72, we're not in a situation where we're overpaying in taxes. And again, that just goes back to running the cash flow analysis, understanding your goals in retirement, and then putting together a strategy through which to spend money so you can meet your goals, but also minimize your total taxes paid over your lifetime. Unfortunately, 74% of Americans statistically do not have a written plan for their retirement, which is just unacceptable, folks. There's plenty of advisors, including the retirement group, that'll put this together for you for free on a complimentary basis, just in an effort to get to know you and hopefully improve our odds of earning your business, assuming you do work with an advisory firm when you leave AT&T. So take advantage of this, folks. Maybe get a couple of opinions. We think we're very good at what we do and have a great track record of working with people in your situation, but it might not be a good fit for whatever reason. So please talk to us, spend some time with us, and maybe talk to a couple different groups to see where the best fit is. These are some of the issues that a lot of our clients have communicated to us that are important to them. What are the costs of the service, and what are we actually getting for those costs? How much time are you spending with us? What issues are you going to help us with? Is it purely just investment management, or is it tax and distribution efficiency? Is it estate planning, Social Security planning, or is it just purely helping us to manage our investments? How much of the AT&T plans do you understand, and what is your track record working with AT&T employees? Many of our clients have expressed interest in a high degree of wherewithal when it comes to understanding all of these rules so that we can make sure that our clients don't make mistakes. What are some of the other areas you'll help us with? Is it healthcare decisions, Social Security decisions? Do you have references that you can offer, which, being that we've worked with AT&T for a long time, we certainly have some references if that's important to you. And then ultimately, do you offer a detailed financial plan, and do you charge for it? Which of course the retirement group does not, as we've mentioned. So get a second opinion. We'd be delighted to give you one if you already work with an advisor. If you have not spoken to an advisor, probably not a bad time to start doing so, given some of these changes that are happening. And if you'd like to talk with myself or Patrick or any one of our AT&T focused advisors, you can email us at info@theretirementgroup.com. You can also call us at our home office at 800-900-5867 to request a 15-minute consultation, whether it's a phone call or a web meeting, or maybe even an in-person meeting if somebody lives in your area. You can also click on or take a picture of this QR code to get access to the calendar and just schedule something for the next few weeks. And also here's that LinkedIn page QR code where you could follow along with the different topics that we'll be discussing throughout the rest of the year that we find relevant to folks that are approaching retirement from AT&T. With that, we're going to wrap it up today. We will open it up for questions if we have anybody, Patrick, or if there's any last minute housekeeping issues you have, feel free to go over those. But I want to thank everybody for joining us today, and we hope to talk to you all very soon.
Yeah, we do have some questions. And, we talked a lot about tax efficiency today. As you know, this is one of the value adds that we bring to the table to try to figure out the most efficient way for someone to enjoy retirement and gain access to their retirement accounts and pay as little as possible to the IRS. And so this question is correlated to trying to help, I guess, long-term with taxes, but also to concern themselves with what's happening in the stock market effectively this year, specifically because the stock market is down. So the question is, do Roth conversions make sense when my portfolio is down?
Potentially. Great question. So the reason it could make sense for a Roth conversion, and I don't know if we mentioned this, but the retirement group uses Charles Schwab as a custodian. So that's where your accounts would be if you should choose to work with us in retirement. We oftentimes, advisors will, toward the end of the year, maybe even earlier in the year, talk with our clients about the considerations for a Roth conversion. So that's when you pay the taxes on money that's in your traditional IRA or your 401k. And move a portion of those assets over to a Roth IRA so as to gain tax-free growth for the rest of your life potentially on that money. And typically we only want to do that when you're in a relatively low tax bracket, at least for what we predict you may be in the future. And that could be because your income is going up in the future, which is why you might be in a higher tax bracket, or it could be because tax rates go up in the future, which is something that many people, myself included, are concerned about for our clients in the coming years as a result of the deficits we've been running. So it's going to be a function of what's your tax bracket and projected future tax bracket. That's why oftentimes when people are still working, this is more difficult to make sense versus somebody who had just retired, maybe living off of non-qualified money and have a very low tax bracket. Oftentimes that's a better justification for a Roth conversion. But when the stock market or when assets are low priced in general, we can get away with a cheaper Roth conversion. And I'll give you an example. Let's say we had 10 shares of Berkshire Hathaway stock in an IRA, and that stock was down, let's say 15% on the year. And we have confidence that stock will recover eventually. We don't know when exactly it'll recover, but if we can move even just those shares, we don't have to move cash. We can literally journal shares over from a Schwab traditional IRA to a Schwab Roth IRA. You pay the taxes on the value of that stock when you do the conversion. So that's oftentimes why it's better to do a conversion when the stock market in general is down or when an asset individually is down in price, because all of the recovery is tax-free, all of the growth at the recovery, as well as it's going to be a cheaper conversion. It's going to cost you less taxes to move it, given that it's lower priced when you did the conversion. So it doesn't always make sense, but it's going to be a function of your current tax bracket or expected future tax bracket, and also the total composition of your assets within your traditional IRA, certainly, maybe even your Roth IRA.
Yeah, and as you mentioned, one of the benefits from our perspective of working with Schwab is it's an unbelievably easy transaction from us, which is basically a request that you do via paperwork to move an existing position, which would allow you to gain even higher growth on when it does rebound. As you assume, we long-term think that stock specifically is going to come back over time. That might even be the ideal time to do that. So good question. Next question: if you're full retirement eligible and or age, and you're still working, can you claim Social Security and put that money into a Roth or other plan of qualified funds, 401k, etc., and not get hit with taxes?
Okay, so there's a lot to this question. It's a great question. This person's still working at AT&T, we will assume. If they are under their full retirement age, which is somewhere between age 66 and age 67, depending on your date of birth, there could be some penalties for collecting Social Security prior to your full retirement age that you would want to be aware of, and earning more than, it's just over 19,000 a year is the threshold to where you can collect Social Security early and still have earned income. So that would be my first consideration is, do you want to take it early? Now, if you are at your full retirement age, you can make as much money as you want and collect Social Security at the same time and not be penalized. So that could be a more viable strategy for this person if they're over 66 or 67, depending on their full retirement age. And the question is, can I take it and then put it into a Roth IRA? So there's some more rules that go along with that, which is income limits on how much you can make as earned income and still contribute to a Roth IRA. If you make too much money, you cannot put anything into a Roth IRA. If you're still working at AT&T, however, you would have access to the Roth 401k. So that could be something we might encourage them to consider. But technically, yes, that money that you collect with Social Security just goes into your bank account. Now it's after-tax money where you would have some flexibility to save that, potentially, adding to your 401k contributions. So your paychecks would be lower, but you'd have additional paycheck of Social Security. Maybe putting into a Roth IRA if you qualify, or maybe just saving in a non-qualified brokerage account wherein there are no income limits or contribution limits. So I guess it's a pretty detailed question that we need to unpackage a little bit and ask more questions to the individual, but it's very possible that could be a great strategy for somebody who's still working in their late 60s, wants to collect Social Security, but doesn't necessarily need all the money. That could be a good way to go.
Okay. One final question that we have, Tyson. How can I take advantage of Roth conversions as an AT&T employee during the markets that are currently down?
It's cut out at the beginning. Can you repeat the beginning of the question, Patrick?
Yeah. So I'll repeat the question. It says, how can I take advantage with Roth conversions as an AT&T employee during the down stock market time?
Great. Okay. Got it. One thing that a lot of people don't realize they have access to in the AT&T 401k is something called an in-service rollover. This is where you take money from your 401k plan and move it to an outside account, such as a traditional IRA or a Roth IRA, or a combination of both is usually what we see. If you have after-tax dollars in your 401k, this could be a great benefit because unfortunately those dollars are earning interest taxable inside the 401k. Whereas if you were to move them to a Roth IRA, they'd be earning interest tax-free and growing tax-free. If you are in a high tax bracket, you might not want to do a conversion this year, unless you're concerned that tax rates are really going to go up in your retirement, and this might be a good opportunity. So that would be something I would talk to the individual about. But it all comes down to the in-service rollover, getting the money out of the 401k, wherein not only do you have more flexibility from a tax efficiency standpoint, but you also have more flexibility on how to invest those dollars. And if you listen to any of our investment webinars, you'll know that we favor value stocks right now, certainly over growth stocks and even index funds, which unfortunately you don't have a lot of access to in the 401k plan. You might have some access if you use the brokerage link option, where you can only put up to 50% of your 401k, but you have a substantially better access outside of the 401k plan entirely in either a traditional IRA or a Roth IRA. So of course, if you were working with us, this could be a good opportunity to do a test run of our services with a smaller amount of money before you retire to see if it's a good fit, or some other group that you might be considering working with. That's something we encourage, is to build that track record before retirement. That's a way you can do that, but it's also a way to get more tax efficient and do things like Roth conversions while the market's down, reinvest that money in somewhere that might have a better growth opportunity than the investments that you have given to you in your 401k plan. And so that's definitely something we would talk on a one-on-one basis when we did the cash flow analysis. Does this make sense for you? And there is also an option to do an in-plan conversion, but you have to pay taxes. And that, again, might not make sense for somebody who's earning more now or having a higher tax bracket now than they'll be in retirement. And oftentimes the conversion outside of the plan can make more sense from a tax perspective because of the flexibility that it affords you. So great question, detailed question, but I definitely want to talk to that person individually before saying for sure whether that could make sense.
Okay, well, looks like that wraps it up for the questions. Hopefully, in the event that you're interested, you could find the link that we dropped into chat for our next AT&T focused webinar that we'll be doing. And so we encourage you to check that out if you're interested. And we, again, appreciate your attention. We hope you found some value in spending some time with us today. And until next time, everyone stay safe. We'll see you.
Thank you, folks.